Well, we've seen plenty of market movement lately surrounding the USDA prospective plantings report, quarterly grain stocks. We're watching the ag economy. We're looking at so many different factors playing into the markets and what is going on with the ag economy. Here to walk through a few things with us, we welcome back to the program our good friend David Widmar with Agricultural Economic Insights. David, always great to catch up with you. Thanks for being on the show today.
Thanks, Jesse. Great to chat again with you this week.
Well, let's dive in here, David. And first off, I mentioned the prospective plantings numbers we got from USDA. Obviously, that kind of sets the table for spring as we look at the acreage battle that is shaping up here across the country. Now, USDA indicating more corn acres, less bean acres. I'd love your thoughts as some of the research that you are looking at with AEI and looking at this acreage battle. What do you see when you look at the numbers and kind of get into the weeds a little bit, David?
I think some of the biggest implications out of the 2023 prospective planning report is not corn and soybeans directly. It's indirect impacts on corn and soybeans, specifically with wheat and cotton. Big
Hmm.
changes outside of the traditional corn and soybean, and they're going to have an impact. We're going to see how these acres ultimately work their way in or out of U.S. corn and soybean production. But one of the things that we wanted to spend some time doing is stepping back and saying, hey, there's this annual battle, but then there's the decade long war on acres and these trends, and these often get lost in the shuffle from year to year. So we looked out. Um, we made nine charts, nine maps to look at this and saying, what are some of the key drivers in this acreage debate? One of them is, there's always this: will corn beat soybean? Will corn be top acres or will soybeans be top acres? When you look around the country, especially outside of the primary corn belt, sort of on the edges of the corn belt, you see that soybeans are oftentimes the most popular acreage at the county level. So we have parts of Kansas in the Delta region, also in North Dakota and Minnesota. Sometimes soybeans are, or oftentimes soybeans are the most popular crop. We also were looking at where acreage shifts. There's two ways to think about shift. Where are producers swinging on a percentage basis the most? We see a lot of that happening again in the Dakotas and in parts of Kansas and the Delta. But when we step back and say, where are the acres coming from? We just see another trend of parts of Illinois actually has been adding a lot of acres into this swing. And what's going on there is Illinois is sort of stepping away from continuous corn, and we're seeing them move a little bit more to this 50-50 rotation. So, we continue to look at this. Where are we bringing new soybean and corn acres into production? Where does the price ratio play out? And how do relative yields impact the equation as well?
And I think it's very interesting that we're seeing some of those quote unquote fringe acres, I like to call it, that are leaning more into core to bean production. And one has to wonder, is it ratios penciling out better for certain farmers? Are certain farmers looking to get into more of that 50-50 rotation you mentioned? Are they sticking to their traditional rotations that they already have when it comes to quarter beans? A lot of interesting dynamics when you kind of peel back the layers, so to speak, there, David.
Right, and we look back all the way back to 2010 for most of this data. You could keep going back. One of the biggest trends impacting U.S. agriculture is this decades-long decline in winter wheat production. And typically, what happens is, if we call these areas the fringe or the edge of the corn belt, what they're doing is they're substituting out of these smaller grains into these higher revenue opportunities with corn and soybeans. And so we see this drop in winter wheat acres or wheat acres. We see this increase in corn and soybean acres, and soybeans kind of at a faster clip than maybe corn. And so this is a huge part of that transition or that trend, that demographic trend that's playing out. And it's also, we talked about this before with you and your audience. It's also where we see farmland values shift the most. We're
Mhm.
shifting, corn and soybeans is a kind of a even Steven trade. But when you move out of wheat production or uh, other small grain crops, you could see a big revenue boost. And so the economics have shifted, and that's a big component consideration. So one of the key takeaways here is the U.S. is simply planting more combined corn and soybean acres. We saw this in the 2023 acreage debate. We'll see if we break that 180 million acre ceiling that we have in place. But we're planting more of that. Those acres, those new acres, are coming from the fringe regions,
Mhm.
if that's the descriptor, or the sort of the edges of the traditional corn belt, as we continue to push that corn and soybean productions to the west in the Great Plains and to the south into the Delta region.
You mentioned farmland values. Would love an update there. Any new analysis or thoughts you've seen just with the current state of farmland values across the country?
Well, we're always writing off farmland values. We're always thinking about challenging our thinking. A couple things. There's been a big slug of new data coming out over the last several weeks, kind of summarizing that 2022 activity. We're still seeing a majority of the surveys showing double-digit increases in farmland values. Now, one thing to keep in mind is slowdown is the word that everyone is using, but that doesn't mean values have been declining. We haven't seen a survey that shows declines. We've just seen increases at a slower rate. And so it's kind of like the idea of, if you're hot, just go outside for a little bit and come back in, you'll feel more comfortable. So it feels like the farmland market slowed down. Maybe some people concerned about that, but it's still a very strong farmland market in most of that. One of the things that we looked at recently is where had the farmland values change occurred the most. Again, we looked at multiple years of data. And one thing that's really interesting is that if you look at changes from 2020 to 2022, this big increase. Where have those played out? Well, it's primarily like a bullseye. It starts right in Kansas, 42% increases per the USDA data. It spreads into the plains, and then it spreads into the Corn Belt at a slower change, but still spreads. And then we see kind of smaller changes throughout other parts of the country. Um, the farmland story has been really big in the Great Plains and in the Corn Belt, but there has been a positive story throughout the whole country. What's really interesting is if you step back 10 years, like in the Southwest and the Southeast of the country, they've seen most of their farmland value increases over the last decade occur in the last 2 years. Now, in the Midwest, we've been seeing kind of a positive story over the last decade, or a lot of positive elements to the story over the last decade. So that's why we've seen some of these really big increases sustained for multiple years.
David, also, I know you guys have been talking a little bit on your AEI website about crop insurance and some of the levels there. Can you touch on that a little bit and just some of the general things you guys are looking at right now?
Well, anytime we get into this time of the year, we have those crop insurance numbers that come out based on the February average price. And that leads to a lot of conversation about corn versus soybean acres. And what we always encourage producers to do is to think about how many dollars of coverage are they getting, how much of their variable costs are being covered, how much of their fixed costs are being covered, how does that impact, how does that change between corn and soybeans. And one of the things that's really important to keep in mind for this year is, one, corn and soybean prices are the second highest observed in history. Soybean prices had a record last year, and corn had a record back in the 2011 to 2013 boom. But these are the second highest prices observed. So on one hand, that seems like it's going to be a good thing, but we have really high costs of production. So one of the things that we see is that if you look at this on a dollars per acre of exposure. So how much of your crop, how much of your total cost, or how much of your fixed cost, you can look at it both ways. How much of that is not covered by crop insurance? And there is a lot of dollars of skin in the game, a lot of dollars of exposure that producers need to be managing outside of the traditional crop insurance tool. That risk management tool is not perfect, and we need to know where those holes are in that safety net, how big they are, and we need to tie that back to our whole farm risk operation. So maybe we're looking to ARC and PLC to cover some of that. That probably isn't as good of a strategy given where ARC and PLC programs are right now. So we got to look to the balance sheet and say, look to our marketing plans. How can we make sure we're marketing grain at these profitable levels to help shrink those gaps down a little bit? But we just need to recognize that there are some challenges when it comes to risk management despite these high commodity prices.
Well, David, great thoughts. Before we run out of time, anything else that you're working on right now, or anything else you want to reiterate to farmers and ranchers who are listening in today?
I think one of the things we have to keep in mind here is that we have tight global stocks. We have tight um, stocks here in the U.S. That's the backdrop for this whole marketing year, and the markets are really focusing on the production side of the factory right now. But one of the things to keep in mind is When we have high prices, when we have tight stocks, we also ration demand. And so we need to keep an eye on this supply and demand equation can change really quickly because of the rationing that's going on. And if we need to see, if we have a normal size crop or a crop that starts to rebuild inventories, we could see stocks of use not change very much, like maybe going from 9% to corn to 11% or 11.5%, something more normal. But we will also have to encourage new demand. And how do you encourage new demand? Lower prices. And so we need to keep an eye on this. I unfortunately think that the range of possible outcomes for commodity prices is very wide here in 2023, given the tight stock situation to the upside and the fact that we've had to ration demand, especially for corn, over the last 12 to 18 months. And if we have a big corn crop or a normal corn crop, we're going to have to turn that demand machine back on. We got to kick in the high gear. And unfortunately, lower prices is the mechanism to do that.
David, if folks have questions, they want to check out the research that you guys have with AEI, what's the best way to do that?
Check out the website, AEI.ag. We have the free Monday newsletter. We also have the subscription and the Forecast Network tool. We have the yield contest getting ready to kick up here in a few weeks. So keep your eye out for that. Great way to stay engaged with that. But AEI.ag is where you can learn all about our work.
Well, you heard him, AEI.ag. With that, David Widmar, Agricultural Economic Insights. Thanks so much for joining us today. We appreciate it.
Thanks, Jesse.